No, we're talking markets, not market structure.
Markets, not
With
market
no
structure.
structure in the talk around.
No structure. Yeah.
No structure to this market discussion.
No structure. We should just
You get that,
start.
Dan?
Like we should just be.
Just
This
riff.
is where we should jump in.
I'm a guitar player. I like to riff.
Okay, we're riffing today. I love it. I'll get my mandolin out. We'll jam. Okay.
Those on Spaces, by the way. As you can tell, this is clearly very organized.
All right. Well, welcome everybody. Welcome to Let's Talk Markets with Dave Lauer. I am your resident co-host, Smooth Brain. Just here to try to help TLDR. What is it? Eli 5. All of these things for the resident Smooth Brains in the house. I'm Pink, and today, as promised, we've been talking crypto and market reform and market structure. And today, we're actually just gonna talk markets. And to do that is the man. We have brought the man, Michael Gayed. So welcome, Michael.
What up, glitches? I think is the way to start off the conversation. Everything's glitching nowadays, which relates to market structure. But yeah,
you got to be careful, Michael.
What up,
with
glitches?
the word glitch. I get.
Am I gonna get canceled for saying glitch?
Yes, people
Really?
hate it when I say glitch.
Wow.
They get triggered, especially if you're talking to the Reddit community. They immediately think of the F4 button. So
Yeah, they're like Dave the Glitch Lauer. Like everything he says, that's the excuse. I don't.
I'm not a glitch. I just have pixelexia. Okay.
Wow. Gonna be that kind of conversation.
It wasn't me. It was Disney. Okay.
Sorry, I
But yeah.
interrupted the intro and everything because the glitch, that word set me off. It's like I've got PTSD from Reddit from the word. I can't
Insert
say
the
it anymore.
PTSD chihuahua. Like
Yeah.
it's like helicopters flying around your head. Oh goodness. Okay, so Dave, let us know, what are we talking about today?
We're talking markets.
We're talking about markets.
Yeah. Is this
That's
so
groundbreaking.
exciting? I know.
So it's all sunshine and rainbows, and I can't wait to dig into it because, everybody in the market's optimistic right now, right? Everything's
Up
going
and
great.
to the right.
So,
That's all, right,
Yeah.
Michael? It just everything's up and to the right.
I don't know. Actually, the whole I need one of you to educate me on where the smooth brain thing came from, right? But it's like I get it. It's like meant to be kind of a joke, obviously, and it's about thinking simplistically. And the reality, simplicity often does work. The right answer is usually the simplest one, but it doesn't take that many curves in the brain to see that we're not in a real bull market, which we'll get into.
well, if you're really smooth brain, you don't know that though, Michael. You have no
Ignorance is
concept of
bliss.
that.
I wish I were smooth brain then, because I think ignorance is very much bliss.
Yeah, that is one of the the bubbles that festered up from the goo of the Reddit phenomenon was insert meme here, Dan, of smooth brain and wrinkle brain. I think Dave was within the Reddit community. I think one of our first officially dubbed and knighted wrinkle brains, and it's just kind of a loving way to refer to each other. There's a lot more derogatory terms used within the community. I think smooth brain is the most inclusive and non-offensive. So yeah, it's a term of endearment, I think, for just a regular everyday investor that, we sort of took ownership of the whole dumb money. Well, not to accidentally plug a movie, before the movie, we took ownership back of that and said, okay, yeah, we're the resident smooth brains. That's what we do. So
in fairness, there's plenty of retail that does not have smooth brains that are very obviously thoughtful and intelligent. I think we all tend to become smooth brains when we follow narratives and like to follow the crowd. Right? It's the brain morphs. Okay, when
for sure
FOMO is there, right? So I'm sure we'll touch on that.
Echo chambers do not usually grow too many wrinkles, for sure.
I think about it. There are definitely two ways I think about it, and one is what you just said, Pink, which is the sort of taking ownership of the dumb money pejorative term that Wall Street would usually assign to retail investors or individual investors. But I think another side of it is, at least the way I think of it, is generally the smooth brain are not they're not dumb. It's just markets are hard and complex. And so they have an expertise somewhere else, right? So this is sort of, this is about, their experience in markets. Many of them are just new to markets. And if you're new, if you don't come into this with a background in finance or experience going through booms and busts, right? Everything can feel relatively new and sometimes hard to explain. I mean, and that's not to say that it's not sometimes hard to explain to professionals either, right?
Well, but I would take that a step further. It's like if I were to put the non-smooth brain way of thinking about smooth brain versus not smooth brain, Daniel Kahneman, big fan of his.
Mm-hmm.
He has this framework of system 1 and system 2 thinking, or rather not really thinking. So system 1 is the sort of embedded in our DNA react function, right? Where we're just responding, we have heuristics. System 2 is the purposeful thinking, right? To me, it's not necessarily about smooth or not smooth. It's really about which system 1 is system 2, right? Are we reacting based on the most recent past, or are we actually thinking about various dynamics to try to see where probabilities might favor an outcome? And that latter part, maybe you need to have more wrinkles in your brain to be able to actually do that effectively. But the point is, it's less about intelligence and more about just slowing down.
Yeah. I think that's a really good point. Everyone wants a quick answer, or that they want a hot take, and
which I'm good at apparently on social media. People think all I do all day long is sit there and talk about cursing and saying "few" and all this nonsense. It's like this is like the smallest part of my day. I do so many other things that most people have no clue about because I'm somebody in the industry. I'm somebody that's an entrepreneur. I'm somebody that's trying to deal with the unknowable tomorrow, just like smooth brains and not smooth brains alike. So
yeah, once you let go of once you accept the fact that you're always going to have naysayers and people against you, and even people trying to troll you and rile you up, your inhibitions go out the window, and you're free to say anything, and be active and speak your mind. And I think that's kind of the beautiful part of the whole smooth brain idea is like, we're all just a bunch of apes flinging what at the wall. And it's like, hey, some of it makes sense. Some of it looks like art. So, and that's said lovingly, by the way, as a longtime member of the community. But the chat is saying instructions unclear, bought more GameStop. So that kind of tells you where we're.
So Michael, let's take a step back real quick. Just for people that don't know who you are, what you do, what's your background, and what do you do when you're not flinging feces on social media?
Well, I appreciate you calling it as it is, flinging feces on social media. Although I'll tell you real quick, just to be clear. So I keep on saying it purposely, and it's funny because people don't seem to get the joke. My Twitter X me is a persona, and it's a persona that's very purposeful. Look, so there's three things that I do. I'll talk briefly about my background, but one is I publish a lot of research, actual real professional research under the Lead Lag Report. Do things like this and talk markets. Two, I'm a portfolio manager of 3 funds I launched, a mutual fund and 2 ETFs, all of which are rules-based, signal-based, which means they run the exact same way if I die tomorrow. And the problem with social media is that people are unable to distinguish between me as a thought leader, researcher, and me as a portfolio manager of strategies that I launched, which are not based on necessarily my discretion, right? So now I had to, it was a conscious communication decision to be a little louder, maybe not a little louder, on social media because last year was so hellish for my approach. So my approach is predicated on this idea that's very simple. Historically, in high volatility for equities, there's a flight to safety that happens in treasury bonds. And if you haven't noticed, treasury bonds have been the source of risk. So I developed these funds that go through a nasty drawdown in a year like last year where treasuries lose more money than equities. What am I supposed to do to try to keep the audience growing when anybody looking at my funds is going to say, why should I listen to this guy? Look at the drawdown he's had. I got to do something different. I got to keep the eyeballs and the eardrums engaged while still being true to my beliefs, right? And framing things in different ways. So, and then the third thing, of course, is I'm a part of a larger entity called Tidal Financial Group. We launch ETFs. That can be a whole other conversation. Okay, so real quick on background. Grew up in the business. My father and mother came from Egypt. One of those American dream type stories. They had no money in their pocket. Were adamant about building a life and a future here in the U.S. Went to NYU, got the MBA. My father found his way into Merrill Lynch, worked for Bob Farrell, started his own investment firm and hedge fund. And I grew up seeing a lot of that. I joined the family business in 2004. My father passed in 2008. Between 2008, the Lehman crisis, and everything else around me collapsing, I had to reinvent myself, reinvent my career. My entire vision of how my life would turn out ended up being the exact opposite. Ended up working at a family office for a short stint, for a year, managing a hedge fund-like portfolio, and then decided I wanted to have more than just one client. So left, joined an RIA, started getting in the media after doing some pretty big writings back then, calls, which I'm actually very much against as a framework now as I've gotten older, and launched a mutual fund, ATAX, the ATAC Rotation Mutual Fund, rules-based, then 2 ETFs, and here I am, still kicking. Not quite getting to the vision I once thought I'd reinvent myself and have 10 years ago, but still out there. A lot of the way that I try to look at markets is to be purposely contrarian, to get people to activate the system 2 part of their brain, to get them to think, right? To get them to not just go with the crowd and not just follow narratives. And I always go back to, doesn't matter if you're smooth brain or not smooth brain, no amount of intelligence can increase the clarity of one's crystal ball. So a lot of things for me are really much more about trying to get people to think differently, not only because it's what I believe, but because I think that's the only way you get closer to knowing the true probabilities of an outcome.
Okay.
I love that approach. That's awesome.
Yeah, totally agree. And I think that the idea of pushing people with contrarian ideas is extremely important, because it's really easy to have blind spots, especially in markets. So let's start with how would you summarize 2023 in markets? How have markets gone, and what's your take on why we are here today?
Yeah. So am I allowed to curse on this?
Absolutely. It's incredible.
Okay. So I'll tell you.
Let
the
it
answer.
out.
The answer I always say on social media is the year can be characterized as totally and utterly fucked. The way that it played out. Now I say that because it gets engagement on accident, but
no, I was gonna do a thing where I was like, so when you say Nvidia is fucked,
right?
What do you mean by that?
How are your puts doing? How is your short position on Nvidia? Even though every time I've said Nvidia is fucked, it has nothing to do with Nvidia. It has everything to do with concentration risk. Okay, it's just, which really few actually understand, which is so funny about the whole dynamic around the few thing. It's like it's a joke, but it really is true. People don't really get that it's not against Nvidia. I'm against the idea that a rising tide not lifting all boats results in everybody drowning. Okay, which is a breadth argument. Right? Okay, so the start of the year, I said very loudly, I believe we're going to see a melt up. I put a post out, I put a thread out January 9th, and I said, we're going to have a melt up because it's a pre-election year. Strongest year of the presidential cycle is the pre-election year, largely because of stimulus. The existing party wants to stay in power, so what do? They stimulate, and recency bias causes people to vote based on most recent nominal growth and activity. But that later in the year, there will be a credit event, that there will be some kind of crash or massive tail event, because interest rates act with a lag. And people will forget that as the market itself is rising. Right now, we went through the fastest rate hike cycle in history. And somehow everybody thinks that that's okay, just because something didn't break. But breaks act with a lag, right? So now, as the year has progressed, you saw this regional bank crisis in March. Okay. And suddenly you went from the melt up, which is pretty broad based, to it being purely centered around the Nvidias of the world, the AI mania. Right? And I kept on loudly yelling, this is not going to end well. This is actually very negative, because you ended up having this concentration of momentum in a select number of stocks that drove market cap weighted averages. Everyone thinking that meant we're in a new bull market, when all you have to do is look at a retailer ETF, XRT. Does not look like a new bull market. Look at a Europe ETF, VGK. Does not look like a new bull market. Look at emerging markets, EEM. Does not look like a new bull market. Russell 2000, small caps. Does not look like a new bull market. So you have a year which I think is one of the most deceptive in history. It looks like a bull market. It looks like a melt up. Right. I myself would argue I actually have been wrong on the melt up, because the vast majority of stocks after inflation are barely up for the year. Right. So this year really can be characterized as the one where idiosyncratic risk, driven by, meaning company-specific risk, company-specific dynamics, really drove the headline averages and fooled people into thinking it was a much healthier market, when in reality, it's sick as hell.
So that's a familiar term there, though, idiosyncratic risk. For those that are, for those smooth brains here, you're mentioning a couple of things that are really ringing a lot of bells that have been speculated about in the Reddit communities, and all of that is to be taken with a grain of salt, but there's some really groundbreaking research that comes out of these Reddit communities. And if anything else, I just have to mention on how affirming it is for you to mention these things after having discussed this, maybe 2 years ago, in the last 2 years plus within these communities that.
Yeah, you have seen discussions there about idiosyncratic risk and systemic issues, for sure. I wonder, Michael, let's start. I want to take a quick step back because I love your Twitter handle and I think it's directly relevant to what we're talking about, but I don't think most people appreciate what lead lag means.
Yeah.
Can you just cover that for a second? And then I want to talk about that in the context of interest rates and systemic risk.
Okay, so I am beyond skeptical of 99% of things that people reference as having predictive power. Whether it's fundamental analysis or technical analysis, most things don't have predictive power. Now, I say that from the standpoint of not somebody that's just saying that without testing. I mentioned in 2008, my whole life changed, right? My father passed, and then the family business closed, and it's like, what the hell am I going to do with my life? So anybody that's been out there trying to find a job knows finding a job is a full-time job. So I still have to make money, right, as the world is collapsing. So I started playing with TradeStation. I started learning easy language, and I started backtesting the hell out of every single possible technical rule you could imagine. I started reading all kinds of research papers and white papers around market anomalies. And guess what? The vast majority of shit does not work.
Nope.
This is fact. This is not my opinion. This is why I often say, the squiggles. I call them the squiggly traders, right? The squiggles meaning those that reference, certain technical patterns. And it's like, I look at these guys and it's like, you know what? You may have gotten it right in a single roll of the die, but if you actually do some real rigorous testing, the shit does not work. I'm sorry. Right?
So you don't like Doritos? You don't like the Doritos of doom and the
Bart Simpson pattern I'm a fan of that actually has some predictive power. But the point is what? The point is that when the whole idea of lead lag is that there are certain things that do lead and most things lag. Now, I happen to put out 5 research papers since 2014. A lot of people roll their eyes when I say this, but you know what, folks? When you're in the media and you're getting new followers, you're in a constant struggle of trying to re-educate people that are new to get them familiar with what you've done already. It's not that you're being repetitive because of ego. You're trying to educate new people that are not familiar with your work that you have these research papers that have won these awards since 2014. All these papers were anonymously submitted. 2 won the Dow Award from the CMC Association. 3 won the Founders Award from NAME. And all the papers have one commonality, that there are leading indicators not to trends, but to volatility dynamics changing, which is what risk on and risk off ultimately is about. Risk on meaning lower volatility for the stock market, risk off meaning higher volatility for the stock market. How you execute is a different animal, right? I mean, the reality is the vast majority of signals have been right the last year and a half saying if it's risk off, play defense, volatility is going to rise. Like, by the way, what's happening now. What failed is the opportunity set of treasuries, right? As the expression of risk off. But the broader point is that I think people end up fooling themselves into thinking that what they're looking at tells them anything about the future. Most of the time it doesn't. But then more importantly, they tend to not understand that which does have some predictive power doesn't tell you about trend. It tells you about volatility.
All right. So let's go a little deeper there. So a lot of people want to know, okay, so over the next couple of months, where's the market going to go? And I see you talking about this on Twitter all the time. You're like, that's not the question. We're not talking about that. We're talking about conditions.
Right.
And I think that's what you're getting at here, which is the indicators that are going to drive volatility, and then how you can position yourself based on that. So what are those indicators that you tend to look at and that you have back tested and found have predictive power?
Well, by far the most accurate is what I call the modern odd lot indicator, which is FinTwit itself. and I say that joking out that I could back this, but I've used that line many times before. It's like, you're right when the counter argument is an insult. Because if somebody's insulting you, they're not actually giving you. They're so embedded in their way of thinking that can't even entertain the possibility that they're wrong, when they can't tell the future better than you can as the one that's making the argument, right? But it's that counter which often tends to be a contrarian indicator. I can't actually test that, but It's beyond Twitter. I used to write for MarketWatch.com, right? I was one of their top writers for several years. And I would see it in the comments. Whenever I would say something that was contrarian take and the comments were vitriolic, right? It's like I was going to be right pretty much almost guaranteed, right, in terms of the thesis. Okay, so broadly speaking, any indicator that tells you about volatility dynamics changing is connected to the demand for money. It's connected to liquidity, interest rates, ultimately, okay, and how demand for money is changing. Okay, so what are the primary indicators that have some degree of predictive power telling you conditions favor higher volatility risk off or lower volatility risk on? Those primary indicators are utilities, the utility sector, relative to the broader S&P, lumber relative to gold. By the way, it's funny to me how many people hearing lumber relative to gold, they don't seem to understand why would you focus on lumber as they comment from their house. Spoiler alert.
You are surrounded by lumber.
Oh my goodness. It's like, anyway, we'll get into it.
It's everywhere.
Treasuries themselves, by the way, treasury bonds are also leading indicators of volatility. Okay. And then the moving average, right? So it goes back to trend versus volatility. If you're above a moving average, it's not so much that you're in an uptrend, it's that volatility is lower. When you're below moving average, volatility is higher. Now, if you go with me that all these indicators, all these relationships, utilities, lumber to gold, treasuries, moving average, they tell you about demand for money changing because of what they, from a cause and effect perspective, tell you about. That matters because if the demand for money is changing, is falling, that's when you tend to have accidents. That's when you tend to have tail events. You tend to have crashes when you're already moving around violently, right? So that's where the framework for me is so critical. Now,
and when you say, real quick, when you say demand for money, you're talking about money supply, not a transition or rotation into cash, for example.
Right, exactly. And I wouldn't even say it's necessarily about money supply. It's more about sort of animal spirits in terms of where to take risk. So why is it that
so leverage, demand for leverage, maybe.
Yeah, and maybe kind of the start of the deleveraging, right? So like, why would the utility sector, the most boring sector of the stock market, outperform in advance of higher volatility for the broader stock market, which on average is the case going back to 1920, is not my opinion, pure fact from the data. Well, it's because investors that are equity long only say, you know what, the things could be slowing down on the cyclical side, so let me overweight the most defensive sector where there's demand for money because there's dividends that get paid out by utilities, making it the most bond-like sector of the stock market. Why is it that lumber to gold is a leading indicator of demand for money? Because lumber is directly tied to housing starts. It's construction, right? So if demand for housing is dropping, demand for money is dropping, and credit contraction is likely rising. The risk of credit contraction is increasing. Same deal with treasuries, right? If you get an inverted yield curve, what does that tell you? It tells you lending is dropping. Demand then has to drop as well, right? As well as supply. Moving average. Why is it that when you're below, for example, a 200-day moving average, demand for money is falling? Because most of the time when you're in a recession, the stock market's already below the 200-day moving average. From an economic perspective, bridge to equities. So everything is ultimately about flows reverting, right, and causing higher volatility, higher risk, right? That's sort of the framework. Now, it's important to note that it's not like every time utilities outperform or lumber to gold is weak or you're below moving average, you're guaranteed to have some massive decline. It's that when you have an accident in the stock market, when you have a crash, usually these areas are already leading. They're already telling you, be careful, right? So it's a very important distinction, right? It's not that you're guaranteed when these signals flip to have something bad happen, but if something bad were to happen, it would make sense that we're already warning you in advance.
So are you concerned that we've been going through September now, markets have been selling off pretty dramatically relative to, what we've seen, I think, in recent history. We're heading into October, which can be a real bad month. Do you go in for that kind of short-term forecasting and concern, or is it just impossible to say right now?
Okay, so I flagged this period very specifically as saying this is a high risk juncture.
Yeah,
I was saying that partially because of seasonality, but also the signals are also saying that. So everything's kind of confirming in the same way, and the complacency, let's face it, is stupid and high. Okay, I mean everyone is just kind of plodding along because they're under this narrative that's new bull market and they're being fooled. And the market, I think, has a funny way of, as I keep saying, bear markets make fools of bulls and bears. Okay, now I think the whole thesis for a credit event happening towards the end of the year was, again, melt up before that credit event, likely towards the end, because we went through the fastest rate hike cycle in history. You have a lot of refinancing of loans on the corporate side that start next year. Right. So after COVID, a lot of companies took on very low rates, and the maturity was around 3 to 4 years. So now they have to roll over their loans, right, into much higher, significantly higher rates than anybody ever imagined 3 years ago. So most crises, as Michael Howell of Cross Border Capital would argue, are refinancing crises. Now, if it starts next year, if a lot of these refinancings take place next year into higher rates, a lot of companies may not survive, the so-called zombie companies, especially in the small cap space. And if that's the case, the stock market and bond market as a discounting mechanism would not respond off of it next year as it's happening. It would respond off of it this year because it would see that that's coming down the pipeline. That's why the path for me was always, it would be towards the end of the year, there might be high risk. Now, I never imagined that at the same time that happened, oil would be rising relative to the yen collapsing, which makes Japan now a risk. China's reopening would be an utter failure, makes China a risk. U.S. credit quality would be downgraded, makes the entire U.S. a risk.
Just today, Moody's came out with a warning saying U.S. might lose AAA because the government shutdown threat. Yeah,
it's like, and this is why I go back to, it is about conditions. It doesn't matter what lights the fire when the tinder is dry, right? This is why it really is ultimately about, is it rainy or not? I don't know what mile marker there might be a crash in, if there is a crash, but I know I need to slow down. Now, that's a really important mental framework, right? The idea of slowing down when the conditions favor an accident. Because I think, and you can correct me if I'm wrong on this, I think a lot of the, in quotes, smooth brain, a lot of the retail, their response is, well, if we're in a risk-off, high-risk period, I got to buy puts, or I got to short the stock market. No. It doesn't work over time. I go back to what I said before. You do any kind of systematic back testing, any kind of rules-based back testing where you include shorting, you're going to go down to zero. So this is where there's a, and I'm constantly battling this on X and in social media in general. When I say conditions favor an accident, that means one of two things primarily. Okay. It means if you're going to play defense, you play defense by being in defensive sectors, meaning utilities, consumer staples, healthcare, things which they would still go down if the market goes down heavy, but down less. And if you're wrong, they're still stocks, so they'd actually still participate on the upside. You have a chance at compounding.
Yeah. So one way is sector rotation.
Right, sector rotation, right? The other way is, and this is where my funds come into play and why it's been so painful, the other way is to play treasuries, long duration treasuries. So those are primarily the two best ways of playing defense, right? It's either defensive sector positioning or playing long duration treasuries. Now, obviously, long duration treasuries have not worked at all, which has been the hell of my own funds, ATAX, Roro, Jojo. The dollar is another way to play it. It's not as good historically as using sectors and treasuries, and gold also tends to be a good imperfect hedge, meaning you can be wrong, still have a chance of making money, but does act as a flight to safety trade. But the point here is that the temptation to want to make a directional bet is not the right framework over time. You might get it right, a couple of trades here and there and make some big money, but if you really want to stay in the game long enough and allow yourself to be wrong multiple times, the way to do that is to play defense with things which are not perfectly inversely correlated, meaning shorting outright or cash, where you don't have a chance of compounding at all.
So you think a lot of people confuse luck with skill?
I think the vast majority of people do. By the way, I will argue until my deathbed that I got very unlucky launching my mutual fund, a risk-on, risk-off fund, the day before quantitative easing 3. Rotating risk on, risk off, equities, treasuries, but more importantly, risk on small caps and emerging markets, which have done terribly on a relative basis against large caps. That I launched at the wrong time. I will go to my deathbed saying I got unlucky launching Roro and Jojo, 2 ETFs that play risk off treasuries, where treasuries have the greatest dislocation imaginable in history last year. Right? I will also go to my deathbed with those funds still open, with me still being the loud SOB that I am, right? Because
Well, do you
I
think
also
ZERP
believe
was
in what I built.
I mean, ZERP and quantitative easing, those are unprecedented, right? We haven't had those. You haven't had those available in a back test, for example. So, you know, it's now that we're renormalizing into a more traditional interest rate environment, do you think that those types of asset classes are going to reassert themselves, or are things just really totally fucked right now?
I hope so, because the reality is it's very hard to beat the S&P when it's the only game in town. Yeah. Including, by the way, if you were an ape or a Reddit, any kind of Reddit retail individual trying to, YOLO based on some individual stock analysis. Like, it's very hard to beat the S&P. Okay, so I'm going to put my CFA charter hat on.
Okay.
So the reality is, I know a lot of people like to focus on individual stocks, but it's not really debatable. I mean, the studies overwhelmingly show what drives returns is asset allocation. Mm-hmm. It's your mixture of asset classes. So it's less about the individual securities. It's much more about the averages.
I think I tend to be someone who's probably a pretty traditional investor in that most of my savings are, following maybe traditional asset allocations with ETFs and such mostly. And then, I've got my personal trading account and I have fun in it and try to, buy some puts from time to time, put money into individual companies. I like, it's fun. But
and it can work. There's no question. My point is, like, on average,
that's also how you get really good loss porn on Wall Street Bets. Like, that's how you get guys losing $600,000 and having to sell the family home. And so
which no one should ever hope for, by the way, right?
Yeah. I mean, absolutely not.
There's a whole other thing. Is like, it's wild to me that people like root for somebody to lose. Like, it's mentally disgusting. Anyway, but okay, never mind that. Okay, so asset allocation is the key to portfolio returns. Okay, so that means if you want to beat the market, the average, you have to choose another average. Mm-hmm. Okay, so how do you do that? How do you beat the S&P? You either have to beat the S&P by being in treasuries at the right time, which is risk on, risk off, flight to safety, right? Because you can counter beta as beta loses money and treasuries make money. Mm-hmm. Or if you're going to be equity only, the only way you beat the S&P 500, choosing other averages, you can only do one of two things. You either tilt small, mid caps, small mm-hmm. caps, right? Russell 2000, S&P mid cap type products, or you tilt international. Like, at the core, that's it. If you're from an asset allocation perspective, from a blunt force perspective, how do you beat the S&P? You have to be outside the S&P, mm-hmm. small or international. Okay, I'm pretty sure anybody that has just been in the S&P 500 for the last decade has been lucky. Going back to luck versus skill, because the reality is that has been the only game in town. Anybody that's tried to do anything outside of large caps, that tried to diversify away from that, failed. They by definition got diluted because it was the number one player, and most people think of the market as the S&P.
Yeah.
Okay. So now, to your point, could that dynamic be now changing? I hope so. Okay. Now, why am I saying I hope so? Because if we're in a world where it's just about large caps, and we're in a world where it's just about 7 names driving the market, 6 names driving the market, 5 names driving the market, what are we doing? In our industry,
what are markets at that point?
What a market to the right? Why are we even trading? Why are we even having communities? Why are we even trying to educate people on risk if that's the only thing to do? Like, think about the implications there of an environment where it's only about the S&P for the next 10 years. So I think, I'm not saying it can't happen. What I'm saying is, if it happens, there's no point to anything.
So there are 2 choices, right? There's go buy SPY, and today it's at trading at 425, or there's something else. So let's put you on the hot seat here. 6 months
solve
out.
Our problems. What is happening?
Solve our problems, exactly. 6 months out, what do you think people should be doing today to have superior returns 6 months out? Is there something specific?
I think, broadly speaking, think of this like betting, right? So it's the crowd is right on average, but wrong at the extremes. And at the extremes where the payout can be outsized because there are fewer people betting on a pot, right? So you have 2 pots that, from a betting perspective, the pot that everybody's betting on, right? In which case you're splitting the payout against so many different people.
Mhm.
And then the pot that fewer people are betting on, which, it might be a smaller pot, but the expected payout is higher, right?
Yep.
So that's why I can be more contrarian in my thinking, which, by the way, still is irrelevant to my own funds, but I think it's important for people to think in those terms. Okay, because again, I always go back to path matters more than prediction. So I live in the world of path for my funds and in the world of conditions prediction for writings and analysis.
I like that way of thinking a lot. Yeah.
No, it really is true. And I think you only appreciate that when you've been humbled, as I have, right? Enough times by being in the business long enough. Okay.
Yeah, that's
Because
right.
again, I'm the first one to say it. My funds have not done well, but I sure as hell believe they're about to come back in a big way if I'm right about this flight to safety dynamic coming. Okay. So if that's the case, what are you going to do for the next 6 months? First thing to do is think. Get out of your mindset around an individual stock. Get out of your mindset around conspiracy theories, because as I said a couple of days ago, not everything's a conspiracy. Right? I find that, I understand you can argue there's always some degree of truth in some of the things that are conspiracy theories when you hear them about individual stocks. But the reality is, if you really believe something is a conspiracy theory, you're not going to change your mind, and you better be able to change your mind if you're going to be good at this game of trading.
Mm-hmm.
That applies to life in general. It's just a good general life rule to have.
It drives me crazy when people say you're flip-flopping. It's like, motherfucker, what are you supposed to do?
We're here to grow and learn, to grow as people. Changing your mind is part of growing as a human.
Changing your mind based on new information. That's crazy.
Which if you're going to use a real technical term, it's a Bayesian way of thinking about things.
Mm.
You just probabilities.
Yes.
And probabilities constantly change, even second by second, when it comes to markets and in life.
Yeah, and if you're not familiar with Bayes' rule, this is a really good time to learn about it, and maybe we'll do a write-up on that so people can understand this way of thinking.
Right, and so the point is being flexible, okay, and recognizing that nobody knows what tomorrow brings, which means being humble, and that means having exposure to as many future paths as possible. Future paths, because it's not about the S&P 500 as a diversified basket or GameStop and AMC and a bunch of stocks that's not diversification. Diversification is about what's the path that happens next.
Mm-hmm.
Because nobody knows which path it's going to be. For all I know, we could be still in a meltdown. Or maybe the meltdown is about to start in small caps and emerging markets, and there's a catch-up trade. And the credit event thesis is wrong. I'll be the first one to say conditions have changed. Not yet.
Mm-hmm.
They haven't changed, right? But that's a path. So just because I believe it's a credit event doesn't mean outside of my funds I'd say sell all your stocks, because it could be wrong.
Yeah.
That diversification actually means still having stocks, even if you believe a credit event or some extreme is out there. Maybe you weight it less probabilities, right? So that's one aspect to it. But the other part of this is, I think if you're going to really be good at this longer term, and what do you do with your portfolio, the best thing to do is not be overly committed and concentrated, in a discretionary portfolio. Don't take on that company-specific idiosyncratic risk, because you know what? For every NVIDIA in the world that's out there, there's going to be some other stock which is down 50%. Right, and like that's really important. I mean, I think people get too sucked into these due diligence narratives and I'd even argue structure dynamics around gamma and shorting and short interest and all that. I don't disagree; it has merit, but how much do you want to position a portfolio based on a single data point? Like that's the issue for me.
Okay. Yeah.
I think it also matters how you're coming to are you coming to investing as more of a gambling approach to try to walk in and walk out? Because a lot of people do, and I think that's what the whole meme stock craze, for lack of a better phrase, brought to this. That's how people were brought to this and brought to learning more about investing, was that they were hoping to get rich quick. But there are a lot of us that have been educated and totally agree with what you're saying. There's way more here to this, to investing, to securing your future, than just picking a favorite stock and DRSing, which is also another approach that I do personally take. But that's just one facet of a fully rounded, a well-rounded portfolio.
Yeah, and
no
look,
investing.
Right, and there's nothing wrong with with in quotes gambling. Okay, just know that the house always wins. Right? It's like, this is the thing with this stuff. If you're going to do it for entertainment purposes, that's a different animal than doing it to generate real longer term wealth. Now, keep in mind, it still goes back to cycles. It still goes back to environments that favor from probability perspective and outcome. I always say there's no gurus, only cycles, which is so funny to me because I say that all the time, and yet people still seem to think that I'm like some know-it-all. It's like, no, I'm not a guru either. I may have gotten a lot of things right, but my funds have not, because they rely on treasury. So getting it right is one thing. Getting the execution from the opportunity set is a whole different animal. And that opportunity set is a function of cycles. And I don't know when the cycle changes, except 2 to 3 years after it's already changed, like everybody else.
Right.
So it's there's a lot of interesting aspects to, the rise of the number of retail participants. I think it's a good thing to have retail and to have more participation. I think it's a bad thing to identify as a stock or to identify as a cryptocurrency and to get stuck in these echo chambers around an individual story for a stock, instead of doing the hard work to learn what's involved to really create long-term wealth from an asset allocation perspective, from a risk management perspective, from the standpoint of knowing what it takes to really do the right thing and be in the game long enough to win.
Yep. I think that's a great perspective. I think it's important for people to hear it. And I definitely appreciate you coming on to share it with us and share your experience and how you see the market. I think you see it in a different way than a lot of people. And I think that's really important to make sure that people hear that. So anything else that you wanted to cover that we didn't hit?
I mean, we're all fucked. I don't know what to tell you. It's no. You don't say so. The big thing is, obviously, if anybody wants to track the work that I do, Lead Lag Report on Substack. I put a lot of, as you can tell, passion into the way that I communicate.
Yeah.
But it's all based on what I believe is right, and I've studied a lot, and I'm a hard worker, and it's been a very, very difficult period career-wise as an entrepreneur, right? Because again, I go back to an environment of treasuries collapsing has been terrible for me, for active strategy, for risk parity, for risk on, risk off, all this stuff. But because I believe in cycles, and because I believe I'm about to, I said it earlier, I said I'm due. People said I'm like pregnant. No, I'm not pregnant.
You're not pregnant.
I'm trying to fast remove, any kind of perception around that to lose some weight. But the reality is, like, if you believe in cycles, then at some point, if you're desynced, you'll resync, right? Yeah. When, I have no idea, but I know that by definition, every single day that goes by, I'm closer to having another shiny object with my funds, hopefully. And hopefully for those listening, a shiny object for your portfolio. Just make sure that you don't give it up.
Okay. Yep. Sounds great. And we wish you luck, of course, on that. And we hope to talk to you again soon about markets and to keep up on it, and even to see you maybe coming on to Irvin Finance and posting some of your thoughts there, which we've talked about in the past.
I give you guys a lot of credit. It's not easy to build a business from one entrepreneur to another.
Yeah.
I support that.
Yeah, thank you. And thanks everyone for listening to Let's Talk Markets. We really appreciate you, giving us ratings, subscribing, sticking with us as we try to educate and spread information about equity markets, crypto. And next week, actually, we'll be talking macroeconomics and markets with Claudia Sam and Ofer Gottlieb from Capital Markets Lab. So really looking forward to that. And once again, leave us your thoughts in the comments. Send us messages if there's something you want us to cover. Follow Michael Gayed. He's Lead Lag Report on Twitter and a few other social networks, I'm sure. And thanks again for joining us. And we'll talk to you next week.